Okay, on to Chapter 10, talking about bonds. Bonds are long-term debt interest. So when a company chooses to finance, a lot of times they will not only finance through equity, stock transactions, but they'll also do debt, which are long-term liabilities, not ownership interest, but creditor interest. Rather than giving people ownership in the company, they'll just take a credit position, pay that back, and once they're paid back, the original owners still just have their own control of the company. So when looking at bonds, bonds are typically issued at a face amount in terms of thousands of dollars. So we'll take an example here in just a minute. A bond that was issued at a $1,000 face amount. This is the amount that's going to be repaid at maturity. Maturity is whenever the bond comes due at the end of 5 or 10 or 30 years, however many. So they're issued at a face amount, but that does not determine the amount of cash received. Now, a bond will have a stated rate of interest, which is the amount of interest that is actually paid. We might have a stated rate of 10% on a bond of $1,000, but we have to compare that to what the market rate of interest is. What a creditor could go out in the market and invest and get a bond of similar risk and what they could receive on their money for that. So if our stated rate of interest is 10%, but an investor could go out and get a bond that pays 15%, we're not going to receive as much when we issue our bond as we would as if our bond was more attractive in terms of the stated rate of interest it has. So that's why we get into the premium and discount. So if we have a bond that, like I just said, has a stated rate of interest lower than the market rate, we're going to issue that at a discount. We're not going to receive as much money as we did as our face amount. But if we say we have a stated rate of 10%, but the market rate of interest is only like 5, which might be the case in the current economy, and investors can't get as much on their money, then our bonds can be more valuable to creditors, and we're going to be able to sell that for above the face amount and get more than our face amount. So therefore, we kind of get into the discounts and premiums and amortizing those over the life of the bond. We'll look at that here in these entries. So on issue, I've written out 2 different examples. One is a premium issue. This is where the stated rate exceeds the market rate, so we're going to get more for the bond than what our face amount is. So I just put $100 in there saying that the bond was worth $100 more to investors than what our face amount was. And now the discount one is the opposite situation where the stated rate is lower than what investors can get out in the market. So we're not going to receive as much upon issue. Now, regardless of what we issue for, we still have to pay this back at maturity at $1,000. This is always going to be the same, $1,000 at the end of the term, but we're not receiving as much up front. So essentially, this is extra interest that the creditor gets by not paying as much up front, and here this is less interest that they receive by paying more up front. Now you'll see that we have a credit to premiums on bond payable. This is essentially an adjunct account, and the discount is a contra account. So if we were to see this on the balance sheet, we would see bonds payable as a credit, premium right below it listed, and we would have a total of $1,100. Here we would have bonds payable listed, the discount right below it listed with a credit, brackets around it, and we would show the net for $900 there. So they go together. And what we're going to be doing is this premium and discount, we're going to be amortizing this over the life of the bond so that whenever we pay back our bond at the end of the maturity of the term, this is going to be zero. This is going to be zero, and we're only going to be left with the face amount of $1,000 or whatever our bond payable is. So as we go through these entries, I'm going to also be referring to Appendix A and B. I want to make sure that you review those. Typically, appendices aren't really all that important, but in this case they are because they bring in present value concepts and the effective interest method for amortizing bond premium and discount. Okay, let's look at amortizing the premium or discount now. Now that we've made our initial entry for the issue of the bond, later on we're going to make an entry to record our interest and amortize the premium or discount. Now here's a quick example based on page 414 in the book. That's issuing bonds at premium. I'm doing a simple example based on that. We issued a bond payable. The face amount is $1,000. The cash amount received is $1,100, so we issued it at a premium. Okay, so we issued it the first day of 2010. It's a 5-year bond, 12% stated rate. That's going to be paid just at the end of the year. Now, remember the stated rate is based on our bond payable amount. So now we're going to get to 12/31. What is our entry going to be? Okay, we're going to be paying interest and recognizing interest expense here. Okay, so we know we're going to pay cash. Cash is credited. How much is that credited for? Well, the face amount times the stated rate, 12%, that's $120. Okay? Now, we also need to amortize this premium. If we were doing it the straight line method, which is what they do in the first part of Chapter 10, not the correct GAAP way to do it, which is shown in Appendix B, but we'll go ahead and do it the straight line way here just so we understand what's going on. The premium starts with a credit, so we're going to need to debit it to amortize it. We'll put premium here. Now, if we did a straight line, which is what they're doing in the first part of Chapter 10, we just take the full 100, divide it by the 5 years, and we would need to take 20 of amortization every period. And then what's our debit to make it plug? That's interest expense for 100. Okay, now see, this interest expense is not really a calculation here. We're backing into this, what we call a plug, because we calculated this based on the face times the stated rate. We calculated this based on what our amortization is. This is the residual here. What is the true interest expense that we paid for the period? Well, the amount that we actually paid in cash, we reduced it by 20 because we said 20 of that is really a return of what the initial premium was. So now if we were tracking our premium account, premium there, we started with 100, we just debited it for 20, and so now we have 80 at the 12/31/2010 balance sheet. That would be shown as an adjunct to the bond payable. The face amount of the bond payable will now be $1,080. We would just do this, if we were doing a straight line, we would do this at the end of every period. So 2010, 11, 12, 13, 14, we would do that entry. After we did all those entries 5 different times, so 20 times 5, we're going to write that down. The premium is going to be zeroed out. So at the 2012, 31, 2014, after we've amortized our premium all the way to 0, we just pay back our bond payable for $1,000, and we're just going to pay cash for $1,000 because we already did those 5 different entries that we just did right before this. We amortized that premium all the way to 0. So at the end of the life, the idea is to get the carrying value, which is the bond payable plus the premium or minus the discount. We want at the end of the life, end of the term of the bond, we want to get this back to the face amount so that we just do the simple entry at the end. Okay? Okay, present value concepts are also really important. They're shown page 416 when we talk about bond pricing, and then also in Appendix 10A. Make sure that you review that as 425 through 427. The idea here is that $1 today is worth more than $1 in the future. We can invest it in the bank and earn interest. We can put it in a business and earn return there. So an investor who is going to give us $1,000 now is going to require more in the future. Now, so if we knew that we were going to pay back exactly $1,000 in the future for something, how much is that going to be worth today? Well, we're going to have to discount that using present value. So if I told you I would give you $2,000 2 years from now, how much would you give me now to make it worth your while? Well, you wouldn't give me $2,000 because you wouldn't earn any money. Your money would actually be worth less in the future. So you're going to discount that based on the present value. Those calculations usually are done using tables, or you can do that using the calculator. You'll start seeing that on page 416, also in the appendix. Make sure you look at that and understand kind of what we're doing, some simple present value calculations. But if I'm going to give you $2,000 in the future, you would just take whatever interest rate you're required to receive on your money and divide that twice. So if you wanted 10% on your interest, you would divide 10% on your investment. You would divide 2,000 divided by 1.1 to get a number, and you divide it by 1.1 again. You basically do it twice, or you could do 1.1 squared, and then you would get your number. So real quick, let me figure out what that is, and you can follow along, make sure that you do the same thing. I'm just doing it here on my computer. So $2,000 divided by 1.1, that's 1818. And we would need to, that would be for one period where we discounted it, and we just do that again, 1818 divided by 1.1. That gives you 1652 or 1653 with rounding. So essentially, if you wanted a 10% return on your money, you could invest 1653 today, and then 2 years later, it would be worth $2,000 if you had a 10% rate of return.